Welcome to the FarrCast, bringing you insights into Wall Street, Washington, and the world. And now here's your host, Michael Farr.
Welcome to the FarrCast. I am Michael Farr. Thanks so much for joining us again this week. Here we are, the eighth day of August. 8/8/24. All right. And you know, a couple of days ago, the world was ending, ladies and gentlemen. World was ending. We got a bad employment number on Friday, and everybody decided that the economy is going to come crashing down because the employment number was off. One number. Okay, the trend has been for a little bit weaker employment and a normalizing labor market. Not a crashing and burning, hair on fire labor market, normalizing labor market. And we got a bad 1 week bads number. And you get Professor Jeremy on CNBC saying we've got to have an emergency rate cut right now. Please, just would you stop it? Stop. Grow up, all of you. Grow up. Let me explain two things about economies and about stock markets. They go up and they go down. And it's normal. And they expand and they contract. They do that. That's what they do. And long-term investors endure all of these things and pay attention to the numbers, and they ignore Professor Jeremy's who scream and yell when they scream and yell. And just think, if you were a Federal Reserve governor voting on the interest rate policy for the largest economy in the world, do you think maybe you want to see 2 weeks worth of data? Huh? How about 2 months? How about you just sit there and take a deep breath and say, well, maybe the world didn't come to an end over the past 5 days, because 5 days ago, the whole damn thing was fine, and now all of a sudden it's awful. This stuff makes me crazy. As you can hear, over 37 years. So markets have bounced back, probably not for the last time. We're due for a contraction. We're due for a pullback. Stocks kept making all new time highs. We've seen stocks up 30%, many of them that have been driving the market year to date. Okay, so we'll have a pullback. This is not the end of the world. What do you do about it? I'm going to tell you what you do about it. And then we're going to ask Kenny Polcari what to do about it. But I say you ask yourself three questions. One, have my long-term goals changed? Answer's probably no. Is my financial position able to withstand a downturn without having to alter my standard of living? If the stock market drops 25%, do I still get to go out to dinner at night? Am I still going to be okay to take my vacation? Can I make my car and mortgage payments? Those are important. And am I prepared to be disciplined and dispassionate as I navigate these emotional periods of exuberance or despair? These are Farr's three key questions. Let's find out what Kenny Polcari thinks about all of this. He is CEO of Case Capital Advisors, Chief Market Strategist for Slate Stone Wealth, and my very dear friend. Welcome back, Kenny.
Well, Michael, I love you and now realize how much I missed you. And I love the energy today because you and I are completely on the same page over the ridiculousness about, Jeremy Siegel, of all people, getting on TV and lighting his hair on fire. Oh, my God. We need this.
You know what? Somebody said, what's he doing? I said, he's getting his ass on TV. He just wants to be on TV. Right. That's all he's doing.
Yeah. Well, it's unbelievable that he would do that. I mean, you would think most people would understand what's going on. But one way or the other, I agree with you. Has anything changed? Has your life material changed? Are your goals still the same? They are. And look what happened. We sold off on what was really a chaotic trade for sure, right? Ignited by the Bank of Japan and their rate hikes. And notice this morning, they all came out and said, oh, we're sorry. We'll never raise rates again when the market is unstable. So we're going to wait, and we're going to just sit and wait until everyone's happy, and then we'll raise rates, which is baloney too. Everyone should do what they need to do. The markets will react how they react. And so Monday was chaotic, driven mostly by algorithms, by the way, which is another thing that people have to understand, right? A lot of the trading is done by, technology, and these algorithms that are written with mathematical formulas that all they know is that when we hit this, when we hit this level, if this technical level, if it breaks, we just have to sell more. We had another one and it breaks, we just have to sell more. And so it feeds on itself and it creates this complete panic. The other thing that I will say is the number of the Dow, the number of the NASDAQ, like the number of the index is much bigger. So, when you look at the Dow, which is trading at 40,000 or 38,000, and it goes down 1,000 points. They have 1,000 points on the television. Everyone goes, oh my God, it's 1,000 points. You have to look at what percentage is that really of the total Dow. That's where people, I think, it gets a little bit also. But in 1987, the market fell 20% in 6 hours.
I was there. Yeah,
right. I was there too. That was very different than what we had on Monday, right? Very different.
And we didn't have the circuit breakers in place in 19.
Correct.
We didn't have guardrails in place to keep things from going too nuts too far.
Right. Those guardrails were actually born out of that event.
Yes.
Right. They were born out of that crash. Today, they wouldn't do it. The market would be allowed to go down 7 full percent, and then it would come to a stop. Right. Everyone would relax. Everyone would kind of regroup what's going on and make sure. If the market opened and traded lower again, it would be allowed to go down another 7% and then stop again for 2 hours.
Right.
Give everybody a chance to regroup. On 87, there were no such guardrails. And so the market just continued to fall.
Right. So, okay, Kenny, so you started out by saying that there was something technical happen, and you were referring to a carry trade. So it was more than just an emotional response here in the U.S., it was fueled by something called a carry trade. And basically, you're able to borrow in one currency at a very low rate. And in Japan, you could borrow at about 0% in yen. And then you transfer and buy dollars with your yen. And then most of the people who do that, because they're so sophisticated and aggressive, they leverage that. They buy on margin with those new dollars borrowed in yen, and then they basically leverage it again. So they're borrowing even more. And as long as everything goes up, it's great. But when it starts to go down, oh my goodness, you've got a problem. Houston, we have a problem. Right. But everybody's got to sell and get everything covered and return the yen back to the Japanese sooner or later.
Well, but to your point, and let's make it clear, that's a very sophisticated, like, hedge fund trade. There aren't individuals playing that game.
Fred and Ethel are not going to Bank of Japan. No,
we're not doing that. They're hedge funds, but that goes to show you exactly the control that, to Mike's point, they borrow the yen, they then convert into dollars, and then they leverage that to buy what? The Magnificent Seven, because that's what's been driving the market all year. And so when the U.S. economy starts to maybe slow down, and when Jay Powell doesn't cut rates, when the hedge funds wanted him to cut them in July, they all start stamping their feet. Then their trade starts. The Bank of Japan then raises rates. It costs them more money. The trade starts to fall apart. So they have to unwind it. And by unwinding it, it's exactly what happened. They have to sell the stocks to raise the money to pay the Bank of Japan back.
And it creates weakness in our stock market. Panic is really a bad strategy. And I've said for years, if you're not the first one, if you're going to panic, be the first one. Because if you're not the first one to panic, you're behind everybody else trying to get out of the movie theater while the other people are yelling fire. No, you want to be the first one out if you're going to panic. Panic's still a really bad plan. So we saw people panic. I did CNBC Monday night. They did a special, and I said, look, this is what panic on Wall Street looks like. Brian Sullivan did a survey on Twitter or X or whatever the hell we're supposed to call that stupid thing now that Elon Musk wants to name everything X. He named the sun X. He calls everything X. Anyway, and Sully said, how do you feel about your stocks? Are you going to hold them? Do you want to buy some now? Or are you thinking about selling? And something like 68% of respondents said they were going to sit tight and hold. Another percentage, 20% said they were going to look to buy, and a very small percentage said that they would sell. Let me tell you one more thing here, folks. When real panic sets in, everybody wants to sell. You don't have 68% who say, I'm going to sit tight. you get to a point in real fear when it's prolonged where they want to sell everything they can get their hands on.
Right.
They never want to see a stock again. They never
Right.
want to talk to a stockbroker again. They hate everything about the stock market, and they're never coming back. We've not gotten anywhere close to that. So this was a flash crash that just lasted a couple of days. I think, Kenny, what do you think?
No, I think you're absolutely right. And that's what creates, I got to tell you something, what's really interesting, I think a lot of long-term investors are getting very warm to this idea that the hedge funds and the algos play. I got more calls from people over the last 2 days that said to me, I want to buy more stock because this is ridiculous, right? They can see it's ridiculous. It's a way overreaction. In my note, I use the analogy, the pendulum. The pendulum swings too far to the right, and then it comes back and it swings way too far to the left, and it's overcorrection. I'm not necessarily saying this, that we've corrected already, because I actually think there's a little bit more downside because we are in this seasonably weak time of year, August to October. And so I do think we're going to retest because it happened too swiftly. There were a lot of trend lines that were broken. And so we need to go back and repair. So I think clients should just be, and this is my conversation, I think clients just need to be prepared for a little bit more volatility and some pressure to the downside until we make it through the September-October timeframe. And then I think listen, I'm long-term bull. I'm in stocks. My clients are in stocks. And so we're all, this has not changed my mind at all.
I have cash, and I keep a pretty robust cash balance, money market balance in my accounts because it suits my asset allocation and my risk model and everything else. My portfolio doesn't look like everybody else's portfolio, but I did do some buying on Friday. That position is it's actually a little bit underwater, but not much. But it's a stock I wanted to own for a long time, and I got a much better price on it than I could have a month ago. I'd wanted to buy it. It came to me, and I bought some. It kept going down a little bit more. Guess what? I didn't get the bottom. I can assure you I didn't get the top. And then
you can't always pick the bottoms.
No, you can't ever. You can't always. Polcari can't always. Farr can't ever. That's the difference. That's why Polcari is so much richer than him.
I was going to say that, but I figured I'd let you say.
Yeah, I'll let you say it. You but I bought a little more Monday morning. I bought something I'd had my eye on for a while, and this is not a recommendation to do anything other than have a discipline. And when the price meets my discipline, part of what I've learned to do is act no matter how I feel at that moment. If the numbers make sense, then I follow my discipline and do what the numbers tell me to do. That doesn't mean it isn't going to go lower. It just means that it's now at a range where I believe it represents significant long-term value. I'm willing to pay that price, and I'm willing to look up 3 to 5 years from now. I'm not going to look at that stock every day this week.
Right. Correct.
I'm not. I didn't buy it to look at it every day this week. I bought it. I know one of them's down and one of them's up. Okay. Does that matter? No, they could both be down in 3 days or both be up in 3 days. I bought them because I want to own them 3 to 5 years from now, at least.
Right. Because you followed your discipline. You were patient. You waited till the price came to you, and then you bought them. You understand what the fundamentals are. You after you understand it, you found its valuation. This is where I want to own it, and that's where you own it. That's exactly what wealth managers and advisors do for long-term clients. We help them manage the process, build them strong portfolios that will weather this storm. And in a storm like this, in a time like this, my clients are in the biggest names and the biggest sectors with pristine balance sheets that are growing their companies that will, they've come under pressure, but they will weather the storm and they will bounce back much faster than a lot of the other names.
I had a young portfolio manager at our company, and a very bright portfolio manager was talking with me while I told him what I was going to do and what I was buying and what I was thinking about and how I was doing it. And the stock market's, down 1,000 points pretty much on the open. And he looked at me at one point, Kenny, and he said, so you really do this, huh? This is how you do one of these down markets. When it really starts going like this is what you do. And I was struck by a couple of things. I was struck that, wow, this is great that I'm having the conversation with this young person, who's learning the business and gets to see firsthand how somebody with my experience does it. That isn't to say I can't make mistakes. I can sure still make plenty of mistakes. But he had never seen 1,000-point drop in the stock market
Right.
in the morning, and he was spooked by it, understandably, and got to see something. And so I thought it was great, but it made me think of all of the other young people out there who haven't been through much of this, Kenny. So I can't believe it, Kenny. We're really almost already out of time here. So give us a message to some of the young professionals out there, what they should be thinking as we go through these Fed meetings through the balance of the year, an election, all the political rhetoric, and what we're seeing on Wall Street. Give the young professionals some advice. And then, of course, what are you telling Fred and Ethel?
Well, for the professionals, and let's start with the kind of the political and the geopolitical atmosphere. While that creates short-term chaos in the markets, it hardly ever prices stocks. So you can't get caught up in it. You can, though, take advantage if it creates negative short-term results, like, some chaotic event to the downside. That creates an opportunity for the long-term investor. So you have to always think about that way. You can't necessarily think that you don't build a portfolio specifically around the political event itself, right? Whether it's our presidential election, whether it's a geopolitical event, whatever it is, you always maintain a well-diversified portfolio. That's number one. Number two is, I think you have to, a lot of these younger guys that are just younger men and women that just came into this industry. If you came in, after 2009, 2010, 10 or 12 years of zero interest rates, which, by the way, isn't reality.
No.
Reality is 5%. That 4 to 6%, but 5% is not usurious by any stretch. So this idea that they want to call an emergency Fed meeting is completely ludicrous, and I hope they don't. I don't think they're going to. I think Jay Powell came out and said, not so fast. We're not calling that and I think that's the right way for him to approach it. Now, whether he cuts 25 or 50 in September, it's not really going to make a heck of a difference, because it's not going to lower the price of your food or lower the price of your home insurance or lower the price of your utility bill. So that's, in my mind, that's fairly insignificant. So that's how I would say to the younger guys in this, younger men and women in this business. To Fred and Ethel, I say maintain the course. Look at your portfolio. Make sure you know what you own and why you own it. And if you're comfortable with it, you're good. If you have any questions about it, you should have that conversation with your advisor, right? If you have a question, again, tell me why we own this, or tell me, I see it's down 8%. Tell me why again we own it. And then your advisor will have a complete answer for you, because, like I say to my guys, we're in the best names and the best categories. They get pristine balance sheets. If the whole market's under pressure, the whole market's under. But these names are going to come back much sooner than a lot of the others.
Kenny Polcari is CEO of Case Capital Advisors, Chief Market Strategist for Slate Stone. Ladies and gentlemen, we do this on video, and I have a personal question for Kenny, because we're looking at each other on video, and I think you all might find this interesting.
Slow down.
How many buttons of the shirt do you decide to leave unbuttoned every day? It looks like, ladies and gentlemen, I don't know if this is like a Miami thing or if this is just an Italian thing, but it's like you've got 6 full buttons. I mean, why do you bother wearing the shirt at all?
I have a polo shirt on, so it's only got 3 buttons, so that's all it's got, and it's hot in this part of Florida where I am, and there you go. I think the point you're trying to make
gold chains. Where are the gold?
But I think the point you're trying to make is I have a hairy chest, and I don't see any on yours.
I don't. It's a very. I don't shave it either. I've got about 6 hairs. I've had them there for a long time, except now they're white, and you can't see anything but the golf tan. But I've always wondered, Kenny, how you decided, because it looks like it goes to about your navel. Ladies and gentlemen, we're going to be right back with Dan Mahaffee on the FarrCast. Please stay with us.
You're nuts.
Thank you for joining us this week on the FarrCast. Now it's time for political analyst Dan Mahaffee and your host, Michael Farr.
Welcome back. Joining me now, as he does every week, now nearing the end of season 7 on the FarrCast, it is the wise and the powerful, the all-seeing Dan Mahaffee, Vice Chairman of the Dr. Scholl Foundation, a fellow for the Center for the Study of the Presidency and Congress, a Washington, D.C. think tank, and probably his most proud title of all, Senior Political Analyst on the FarrCast. Welcome back, Dan.
Thank you, Michael. Always great to be talking with you. And yes, the the proudest of all my titles, of course.
Well, it would have to be really, Dan, and other than son of Pam. Son of Pam is a pretty good title. Okay, so Mahaffee, I was thinking before we came on today that we were wrong in our vice presidential picks, and then I've decided that one of the three of us is wrong in the vice presidential pick. Either Mahaffee's wrong, or Farr's wrong, or Vice President Harris was wrong in her VP pick. You were looking for Kelly from Arizona. I was looking for Shapiro from Pennsylvania, and I'm still stomping my foot on Shapiro because you have to win Pennsylvania. That's why. That's all. That's it. I mean, I can hammer that one for the next 3 months pretty easily. You have to win Pennsylvania, period.
Yeah.
Tell us what you think about Mr. Walz.
Well, before I get to Mr. Walz, I'll tell you at least the two top reasons I hear why you and I were wrong. For Kelly, it was concern over taking the Arizona seat and putting that back up for grabs again in the Senate. And with Shapiro, how much of this was a whisper campaign and how much of it was true, but that his past experience as a reservist in the Israeli army, I don't know if this was birthright or something similar, but his past stances on Israel would be used against him by the progressive, the more anti-war elements in the party. So those were the two that we picked and we were out. And Walz, I think, is among the party at least a non-controversial choice. I haven't heard moderates complain. I haven't heard progressives complain. He's done a good job of uniting. A big critique I would hear from anyone would be one that he doesn't have any private sector experience really to speak of, that he's largely been in government politics. He was a teacher, and look, teachers do the Lord's work, but certainly no experience with a business, running a business, anything like that, a public sector and political career. Some, of course, have also looked, as anyone who does this, they'll put his military record through a fine-tooth comb, but I don't see other than whispers about whether he exaggerated his service or anything like that. There's no, I don't think we're going to see any swift boating of him or anything like that, like we saw there. And finally, I think from a strategy standpoint, the kind of person that he is really demonstrates, I think, that they want to appeal to that voter that in those districts that extend from Minnesota through Wisconsin, through Michigan, into Pennsylvania. Those are the ones that they think where this election will be decided. Arizona, Georgia, sure, those are icing on the cake, but this is all won or lost in a swath from Pennsylvania into the Upper Peninsula of Michigan, and that's what they think that Governor Walz will have the appeal for.
Are they right?
Ask me in November, Michael. That's the
no. I can ask everybody in November, Mahaffee. I'm asking you now. Come on.
Look, I think if they are right, it's because
ladies and gentlemen, you know, we talked about Kenny Polcari and that we were on video and that he doesn't unbutton his shirt. He doesn't button his shirt much above the navel. Mahaffee always has his dog on the sofa behind him. And even the dog seems to be completely full rapt attention right now to hear what Dan's going to tell us about the Veep. Does the Veep have a dog? The Veep must have a dog.
I'm sure he does. I think I've seen also a cat on social media, but
Dear God, not one of those cat people.
We'll see. Look, the Veep, at least so far, I think helps because it does no harm, and there appears to be a good rapport, and that's what they're saying. Good vibes between Harris and Walz. He's been well vetted. Look, if you do a political Hippocratic oath, that's the best I can say on how this would work out, compared to how some of the second guessing has been going on the Republican side. You don't see that about this Veep pick yet, but so far, like I said, he's really managed to bridge both sides of the party in a way that some of these other picks might not have.
Okay, so right now you think, okay, when I look at Walz, I think he seems like a nice guy. I'm not. I'm an independent, registered independent. I have voted for party candidates from both parties over the years. I try to vote for the best candidate, and I'm not constrained by party. But I don't say that as a political comment. But I think, Ronald Reagan and Bill Clinton and Barack Obama and others have taught us that being likable matters. And I think Richard Nixon taught us that being likable matters from the other side of that coin, frankly. So he seems like a likable guy, and perhaps more likable than Vice President Harris, even the way I feel about it. This is a guy you want to go sit down and have a beer with. Do you agree or no? Does it matter as much as I think?
Well, and I think there's always that proverbial go have a beer with the candidate. I think there's also the sense of, at least among social media, he's done a very good job of harnessing this sense of weirdness. He's the one who has used this term to describe the Republican ticket. He's seen it resonate, and for Democrats so far, at least as messaging goes, look, it certainly doesn't unify the country to call the other half weirdos. It sounds a little bit high school cafeteria after all. But look, that's politics in the year of our Lord 2024. And what you're seeing is that the message of weirdos is resonating among young people. It works on social media. It's pithy. It really resonates when young people are concerned about social issues and culture war type topics. Then you also have this message, though, resonating with the swing voter, the independent voter, the voter who, let's think about them, has probably voted Clinton, Gore, Bush, Obama, Trump, Biden, and doesn't really know what they're doing now. So look, they've been a voter that's all over the place, and it's probably not going to come down to policy specifics or bona fides, but that sense of just downright likability.
We've seen a poll from CNBC this morning where Donald Trump is still 2%. All the numbers are higher. All the percentages are higher, but Donald Trump is still 2% higher than Kamala Harris. What do you make of that? It seemed as if the sentiment was shifting. Is the CNBC poll as good a poll as some of the others, or are they on to something? Is there just a little more enthusiasm on both sides now that we've got a real race and Trump's still in the lead? Do you believe it?
A lot more enthusiasm than when we were coming out of that first debate between Biden and Trump, certainly enthusiasm on both sides. I stand by what I said when the change was first made, though, that this has reset the race back to that 47-47 country. I think it puts it back not to the landslide that Trump and his advisors were dreaming about when they were still running against Biden, but don't interpret the momentum that that Harris has now. Don't overinterpret that momentum. They do have wind behind their back. They've landed this pick well. There's a meme going around that quite honestly reflects a sentiment. I don't recall the Democratic Party capably handling this many things in a row. That's one sentiment I'm hearing, that, and it's what it's done is turn one party, which was particularly glum, into feeling rather hopeful. And that has, again, I think, reset it to a pretty even country. But that's again going to be interesting as we see this debate. If as I said, Act One, Act Two, the switch in characters has been Act Two. The switch in the protagonists on the Democratic side. I think Act Three begins when they finally get to a debate, and you see Harris off the teleprompter and Trump again now contrasted with a younger candidate.
I keep hearing tick tock, tick tock, tick tock in the background, that time's winged chariot is drawing near. You get sort of towards October, and the political wisdom in Washington is people have made up their minds. You could have the same vote first week of October you're going to get in the first week of November. It's already done, which gives you about 6 weeks left to change people's minds and to see if you can get enough people on your side of the boat. Is it enough time? Is it enough time for people to sour on Kamala Harris? Can she hang on to the momentum? Will her campaign staff be able to keep her away from an open mic and keep her on the teleprompter?
Yeah.
Because it's working on the teleprompter, Dan. She has appeared very presidential. Why, if it's working, she's getting more fundraising
Sure.
and she's executing. Why would you ever take her off the teleprompter?
Yeah, don't unless you have to. Continue to focus on the message that is hitting the, hit the Republicans as being out of touch, as being, quote, weird. Continue to use that messaging. And again, don't go for any unforced errors that you would have going off the teleprompter. That's a strategy, and it makes sense for them to continue with that strategy. I think for Harris, the risk or opportunity is that they do have more of that opportunity in that time frame before October, as you mentioned, to either change opinions or cement narratives about them. On the other hand, the problem for Trump, and this could be, again, a benefit if it comes to banking votes, but a problem for Trump is there's really no changing your opinion about him during this window. Harris is the one who has at least the most freedom of action, at least in the campaign. Trump, as far as we know, is a known character for all the voters, really.
Okay, so Dan, if you had to call it now, you're still call. I know you've said it's back to an even toss-up. You think Trump still wins this?
I think Trump still wins this, but let's see where the momentum is after that debate.
You think he's going to debate, or is he not going to debate?
I think he has to, given that he's now in his press conference that was going on just before we came on, saying that he wants 3 debates now. He's speaking himself into a corner on having at least 1 debate. So and to not go ahead and have one would be unprecedented. So I think he has to.
You think he has to? Okay. And in the debate, Vice President Harris, it doesn't do the word salad thing in a debate, or she didn't in the others. She was on point and she was very much on attack. So you think she can do that again? Is that a safe format for her?
I think she can, but she has to, again, pull off the staying on point, not getting dragged into too many of the other back and forths or ad hominems. Trump will try and pull this into the muck and, try and make this a debate that will be less about policy and substance and more about attacks.
Okay. All right. Dan, there's a rest of the world still going on out there, and we've got about a minute to get to the
Only
rest.
a minute for the rest of the world. Goodness.
Well, I know there are those protectionists who think that that's too much. There's some more globally minded that think it might not be enough. Middle East, give us your take. Give us your take on China and, of course, on Ukraine. Give us round the 3 bases for us, and then bring us home, Dan.
Yeah, I think Middle East, we're waiting to see the scope of the Iranian response, and the wild card there compared to what happened in April is how much the other Arab countries, Jordan, the Gulf states, Saudis, help this time, given how much the patience is wearing thin with Netanyahu amongst them. China continuing to see the economic numbers lag behind. Any kind of outside economic trouble certainly doesn't help if there's a global economic slowdown. China feels that at the same time its economy is already feeling domestic pressure. So that, again, compounds what we've seen there. Finally, in Ukraine, each side has some successes here and there, but it reminds me of the textbooks of the stalemates of World War I or the Korean War, where each side pushes a little bit here, each side pushes a little there, but you don't really see the front moving. Russia's advantage in men hasn't changed, but it still remains how long does the West support? And eventually, what does the framework for some negotiation look like? Because neither nation has the ability to decide this on the battlefield.
Okay. All right. Dan Mahaffee from the Dr. Scholl Foundation, Center for the Study of the Presidency and Congress, our senior political analyst. Thank you, Dan, very much. We're going to be back, of course, again next week and see what's happened in the past week, how we got it and made it over the weekend. And I understand that President Biden is on his way to Rehoboth Beach tomorrow. He'll be right I can't quite see his house from here, from my porch outside my office here, but it's awfully close. He's about a half a mile as the crow flies. So I'll be here with the president. You know, you always feel a little bit safer. There's a 50 caliber gunboat behind my house every minute he's here. You're not getting near my house. I don't know who's going after what down here.
They're definitely upping how they enforce the catch limit for the local anglers.
There's no question about it. And there is a serious naval ship right off the beach. Okay. We're going to come back with Bryn Talkington when we're back to see if she agrees with Polcari and what she's watching in terms of the economy and stock markets. One of the smartest people out there. Please stay with us.
Michael Farr and the FarrCast are proud to support Heroes, Inc. Heroes supports the spouses and children of law enforcement officers and firefighters who gave their lives in the line of duty to the greater Washington, D.C. community. Their singular goal is to honor the supreme sacrifice made by these individuals by caring for their families. Heroes' work begins within 24 hours of the tragic loss and continues indefinitely. We invite you to learn more about Heroes' mission at heroes.org. We hope that you will consider supporting Heroes as they endeavor to honor those who protect us. That's heroes.org. Heroes, here for you, here for good. And now, back to the FarrCast and your host, Michael Farr. We appreciate you listening into the FarrCast this week. And now to introduce this week's special guest, here's your host, Michael Farr.
Welcome back to the FarrCast. Thanks so much for being with us again this week. 8th day of August. What a week it's been, folks. We have been down into the lows, climbed down into the depths of the basement, and we're back up and can see some sunlight. Maybe we had a little prolonged flash crash there, a little emotional tantrum from investors who decided that they wanted a rate cut now, that the Fed had gotten everything wrong. And as we suggested with Kenny Polcari earlier, perhaps cooler heads need to prevail. Perhaps we need to study the data. Yeah, maybe it might not be as soft a landing as people hope, but it's still, I don't see signs for things that are cataclysmic or awful. So steady as she goes if you're a long-term investor. What do we do when we want to know more? We go to the smartest people on Wall Street, and I'm going to tell you one of them is Bryn Talkington, is one of my great buddies on Wall Street. She's managing partner of Requisite Capital Management, CNBC contributor, and just one of the nicest people you're ever going to meet. Hey, Bryn, welcome back.
Thanks, Michael. So glad to be back. I think this is my third time, so I get a turkey, right? I did a turkey.
You do? Oh, Harry, send the turkey, will you please?
Right?
Oh, yeah. I didn't know that you knew about the turkey thing, but yes.
I'm a bowler. I'm an avid bowler.
Perfect.
Avid bowler.
So the turkey, the three turkey is coming. Bryn, what do you think's going on? Stocks are doing okay as we're coming into the end of the week. We're making up for a lot of the damage that was done. Mm-hmm. How do you see both sides of it?
I think if we go back on Thursday, we started seeing the VIX rising. And so then we got
what's the VIX for those not in our business?
Right. So the VIX is really going to be the inverse move of the S&P. And so when the S&P is going down, the VIX is actually going to go higher. And it's a measurement of the volatility in the market. Okay. And so the VIX, the volatility in the market had been really low for the past couple of years. And then starting on Wednesday, Thursday, we started to see that move higher. And I think that when the unemployment number came out, I guess it was Thursday, right? Wednesday, Thursday. And we saw a jump in unemployment to 4.3. That is, I think, where originally people thought, well, that's why the VIX is rising. So I have two things to say. Very early on, Tom Lee came out and said, I think this is a bad read. If you read the BLS report, the Bureau of Labor Statistics, it said that Hurricane Beryl had no impact. And then after that, Ed Yardeni came back, really echoed similar thoughts to Tom Lee to say, hey, Ed Yardeni had a great chart about there's 1.5 million workers that were disrupted because of Beryl. So I live in Houston. I'm telling you, this was a disaster. We have 6.8 million people in Houston. There were 7 to 10 days when people did not have electricity and internet. So I call BS on the BLS report. I think that Tom Lee and Yardeni were spot on. Okay. But the market, let's say, ignoring that, volatility starts coming up. And then we started hearing about this yen carry trade late last week. Monday, to me, was the black swan. It was a black swan event where you had the VIX had the second largest one-day move in 34 years. So this is not about the jobs report. This is an unwind of this carry trade, which had been around for a long time. And so I think this was more about the mechanics of the market than about anything investor driven. And what sold off? You saw Bitcoin, cryptos, which typically can get levered up. They really were oversold. You saw NVIDIA, which I think there's probably a lot of leverage in that stock as well, really get sucked down. And then all of a sudden we get this report today, which is really like, I would ignore it. I don't think the unemployment report today is all that important, the weekly report. I think it gave people a reason that the carry trade unwind is largely done. And now let's get back to focusing on earnings, which have been good. The economy, I think those hardliners that are hoping for a hard landing are going to have to wait a little bit longer. And I'm going to be in the Yardeni Lee camp that they're going to come back and actually the BLS is going to say, yes, there actually was an impact.
There was an impact. Kenny Polcari and I talked too about the carry trade, and I think we gave a reasonable explanation of what a carry trade is. But at the end, it's a leverage trade conducted by institutions, sophisticated institutions. That's a very aggressive trade. And I was just thinking about it after I finished talking with Kenny, Bryn. It's one of those times where it makes Fred and Ethel, my average investor, Fred and Ethel, makes Fred and Ethel feel like the system and investing might not be for the average Joe, that this is a game for big boys, or that perhaps it's a little bit rigged. And while I don't feel that way, I'm interested in how you might react to that, because I know that some of them out there are thinking it.
Well, I mean, I think it's not a rigged market. It's like there's a lot of dark pools of money. There's a lot of leverage. And the carry trade's been around for decades, right? Whether you're
Yes.
long and short, but the yen, when you have low rates and you have the Bank of Japan owns 80% of ETFs. I think between the Bank of Japan and the Japanese pension fund, they probably own 10 to 15% of Japanese equities. I just think you have to understand when those things occur, like a long-term capital management that happened in 1998, when those things unwind, it can seem, disconcerting for investors. But as you just see, if you just like turn the TV off and understand that volatility is the price of admission, then you just move on, because what changed from Monday to today? Nothing. It's the trade unwound. And so I do think investors need to understand there's a lot of undercurrents in the market, which will cause things to occur that don't seem normal, but actually they are normal. And so we actually used Monday for clients that we're doing dollar cost averaging for, like on a monthly basis, to pull that forward and go ahead and do the dollar cost average on Monday, because we thought that was somewhat of a gift, because we did think it was mechanical and yen based, not unemployment based.
Right. And yet that volatility, if you really react to it, can be kind of devastating. I mean, in video, and some of these numbers, Bryn, get me because I guess I'm just not used to them. I mean, I'm done this so long, but to see companies with multi-trillions of dollars in market cap is stunning to me. I still can't get that through my head. But you look at an NVIDIA with 2.5 trillion in market cap that goes down 15%, 15%, and all of a sudden you've got a $300+ billion drop Drop in market
Yep.
cap
Well,
of one company. I mean,
yeah.
and it's bouncing back hard here. I mean, that's a huge bounce back, right? From where
I think you also, and this is like not going to have a lot of this, I would call it tourist capital. It's capital that are trying to make these moves in one day. They end up getting flushed out, but it can cause a tremendous amount of volatility.
Yeah, and I love the tourist capital, tourist investors, the folks who don't come to stay. It sounds like, Bryn, that your message over this period of volatility would be ignore the noise and focus on the price of fish, is what they say in the fish market, and also focus on the long term. Are you thinking there's going to be a soft landing? Is there going to be a slowdown in here? It is the Fed's talking about cutting rates. They're responding to some sort of slowness in here, aren't they?
Well, two things. I think ignore the volatility if you're fully invested. We do a lot of covered calls. We're big fans of selling, owning a stock and then selling a call to collect another form of income. And so a stock that's just capital appreciation, you can also get, call premiums. So in this period of volatility, those call premiums really skyrocket, which is great for sellers of calls. I think, though, that the Fed, unfortunately, the Fed has only, since the existence of the Fed, has only engineered a soft landing less than 10% of the time. And so, whereas, Jeremy Siegel on Monday was calling for whatever, 50, 75 basis point rate cuts, I don't think that the Fed needed to step in because of the unwind of the carry trade. I think you just needed the head of the Bank of Japan to come out and say, we're not going to do that anymore. We're not going to raise rates. And so I think if I look at history, the soft landing by the Fed, they're always late, Michael. They always are so data dependent.
Yes.
And my bugaboo with the Fed is that they have 400 and some odd PhDs all looking at the same data, like all looking at the BLS data, and like they're looking at the same stuff. And so what you would expect from the Fed is like, hey, look around corners, try to look around corners, make a forecast. And I do think where Jeremy is spot on in terms of the direction, maybe not the magnitude, Jeremy Siegel, is that you have core PCE, which is what Chairman Powell uses at 2.6. We have GDP, which is not a gauge of inflation, right? It's a 2.8, but you have Fed funds at 5.25. And so you have this really restrictive, you have over 200 basis points of wiggle room that the Fed could take, and you are seeing unemployment kick higher. And so I think just in terms of the Fed, they want to wait until they're certain. We would expect September that we're going to start getting a rate cut. But as you know, the Fed doesn't want to cut rates one time. They want to go and be able to do it, through a cycle and start having a rate cut cycle. And unfortunately, history doesn't bode well for them being able to engineer the soft landing. But maybe it is that 10% of the time that they did do it.
My fingers are certainly crossed. And
me too.
Yes, I mean, the old rule is you get a minimum of 3. Whatever the Fed does, you can expect at least 3. Mm-hmm. And what one of the things that I've been saying for several weeks here is the most important thing you can pay attention to for markets is that the Fed is changing policy. The Fed is pivoting position. The Fed is going to accommodation. Whether we get that slowdown or whether we don't get that slowdown, the Fed is changing their stripes. And when they do that, yes, you can continue to get the slowdown, but sooner or later these things bounce. I haven't verified this, but there was a chart on X on Twitter. So now, listeners, please beware. But it says that every time that CNBC has a market catastrophic crisis special, did you see this?
Markets in crisis. It's a markets in crisis stock chart.
Crisis thing that you can make something like 40% within the next 12 months from that particular day. Yeah. They called me in. I was on with Ron and Sana at 7:00 at night because markets were in crisis. I bet I have been on 70% at least over the last 20 years that I've been a contributor for CNBC. I bet I've done 70 because I'm like the calm guy. I'm the guy they call when things are in crisis.
Love it.
They don't call me to figure out how to leverage a trade or how to get aggressive because I don't know how. So the calm guy they call. So this is great. I can't believe it. I'm out of time. Would you give us some advice to Fred and Ethel, who are looking at what's going on in the markets, who are looking at this upcoming election, and are kind of worried about their portfolios and 401ks? And folks, listen, because Bryn Talkington is one of the best people you're going to hear from.
I would say hire a good advisor and don't worry about it. Go live your life and hire a good advisor and let them worry about it.
That's right? Great. I've said for years that I get paid to worry.
Right.
And I've looked at people and said, actually, you pay me to worry for you. Stop worrying. I'm doing it. Otherwise, you mean, it's like hiring a cook and going into the kitchen and cooking yourself. Don't bother.
100%.
I'm worried. I'm doing it. We're paying attention.
That's right. That's my advice.
Okay. I'm loving it. I know Harry is too, and we love having you. Thank you, Bryn Talkington, managing partner at Requisite Capital Management, CNBC contributor, absolute sharpshooter on Wall Street, and my great friend. Thank you, Bryn.
That's a wrap for another episode of the FarrCast. Thanks for joining us this week, and thanks to our guests, Kenny Polcari, Dan Mahaffee, and special guest, Bryn Talkington. We hope you enjoy the show as much as we enjoy making it for you. The FarrCast is produced by Michael Farr and Harry Jennings and comes to you weekly for free on all major podcast platforms, including Spotify, TuneIn, and Apple Podcasts. You can stream past episodes and subscribe so you never miss a new one. Please be aware that anytime we or any of our guests mention a specific company, sector, or refer to performance in relation to an earnings report, news headline, or economic trend, it is not a recommendation to buy or sell. View the risks and rewards of any investment with your financial advisor for what specific investment and general strategy is appropriate for you before you make any investment decision. As always, we can be of assistance at Farr, Miller in Washington. Please reach out to me at hjennings@farrmiller.com. We are here to help, and I'm happy to arrange for any of our listeners an appointment with one of our financial professionals to review your portfolio, your needs, and your goals. We love reading all of your notes, and we try to reply to as many as we can. You can reach us at hjennings@farrmiller.com. Let us know any questions you have about past episodes or questions you'd like us to address in upcoming shows. Take care, stay safe, and stay healthy. And thanks for listening to the FarrCast. Wall Street, Washington, and the world. Farr, Miller in Washington is a group comprised of investment professionals registered with Hightower Advisors, LLC, and a SEC-registered investment advisor. Some investment professionals may also be registered with Hightower Securities, LLC, member FINRA and SIPC. Advisory services are offered through Hightower Advisors, LLC. Securities are offered through Hightower Securities, LLC. All information referenced herein is from sources believed to be reliable. Farr, Miller in Washington and Hightower Advisors, LLC have not independently verified the accuracy or completeness of the information contained in this podcast. Farr, Miller in Washington and Hightower Advisors, LLC and any of its affiliates make no representations or warranties, expressed or implied, as to the accuracy or completeness of the information or for statements or errors or omissions or results obtained from the use of this information. Farr, Miller in Washington and Hightower Advisors, LLC and any of its affiliates assume no liability for any action made or taken in reliance on or relating in any way to the information. This podcast and the materials contained herein were created for informational purposes only. The opinions expressed are solely those of the authors and do not represent those of Hightower Advisors, LLC or any of its affiliates. Farr, Miller in Washington and Hightower Advisors, LLC or any of its affiliates do not provide tax or legal advice. This material was not intended or written to be used or presented in any way to any entity as tax or legal advice. Clients are urged to consult their tax and or legal advisors for related questions.